Well, good morning, everyone, and welcome to the Peterson Institute. Getting a little bit of an echo here, but we can manage that. My name is Roger Ferguson. I'm one of the trustees here, and today at this event, we have the pleasure of hearing from Austan Goolsbee, who is the president of the Federal Reserve Bank of Chicago. As the president of that bank, a position he adopted in 2023, or was appointed to in 2023, President Goolsbee is part of the Federal Open Market Committee, which all of you know is the monetary policy arm of the Federal Reserve System. In addition, as president of the Federal Reserve Bank of Chicago, he oversees staff in Chicago, Detroit, and other locations in the Midwest, where the roles are research and statistical support, understanding and overseeing bank activities, and providing financial services to both regional banks, local banks, and also to the U.S. Treasury. So without further ado, let me call President Goolsbee to the podium. President Goolsbee, the floor is yours.
Okay, thank you for joining. What do we got? A little bit of a feedback going. Is that any better? Sure. Is that better? I'm gonna go with this pedal plan, But so we got it. Thank you for joining us today. Joining me today. Can we call it the slides? We'll get in a second. I have an intro, but I'm going to get to a couple of slides. When I finished graduate school many years ago, I was headed to Chicago, and my grandfather called to give me advice. And Grandpa Jack lived on a ranch outside Abilene, Texas. He had served in World War II. He was one of the greatest generation wise men type of figures. So whenever he had advice, I was open to it. He called me that day to say, this is going to be your first job of your career, and you're going to need to save money. He says, so let me tell you something very important. Never buy stocks. And I paused for a second and I said, wait, is my Grandpa Jack is a fish and markets guy? Or like, what? I said, no individual stocks. No. He said, don't ever buy any stocks. Your grandmother and I had friends who bought stocks, and those people lost everything when the market crashed. Okay, he was thinking of the Great Depression, and that one historical event so scarred his thinking for 65 plus years that it led him to miss out on several 1,000% cumulative return over the entire time. And at that moment, I realized that Grandpa Jack's life experience, the very thing that made him a font of wisdom about many things. And as an example, his background in meteorology in World War II meant he could give you a stunningly accurate weather forecast just from looking up at the cloud formation. For all of his wisdom, it became clear that in personal finance, at least, not every historical lesson is helpful for every moment. And today, I'm going to make the argument that the same thing may be true for monetary policy, in that history has taught us repeatedly that bringing down high inflation without causing a major recession is an extraordinarily rare and difficult task. That traditionalist view, I'm going to call it, tempts us into looking at current growth and labor market conditions as the primary predictors of whether inflation is returning to target. And I'm going to argue that traditionalist view misses some of the key features of our recent inflationary experience, and that at this moment, believing too strongly in the inevitability of a large short-run trade-off between inflation and unemployment is coming with a serious risk of near-term policy error. That traditionalist view, which says that the substantial resource slack generated by a deep recession is necessary to reduce strong inflationary pressures, also says that delaying in taking the bitter medicine can result in unhinged inflation expectations and make the job even more difficult. And this is rooted, of course, in the U.S. historical experience of the 1970s and 80s that's etched in our minds, but other economies around the world have similar stories to tell. Before continuing, let me bring some relief to my colleagues by giving the disclaimer that the views I express today are my own and not necessarily those of my colleagues on the Federal Open Market Committee or the Federal Reserve System. So to begin, as I noted, bringing inflation down several percentage points in a reasonable period of time without suffering a severe recession or painfully high unemployment is historically quite rare. Many commentators have that historical perspective in mind when they argue that returning inflation to the 2% target will inevitably be painful. That perspective is also a feature of many econometric models in a long established literature that identifies the effects of monetary policy shocks. The results from that literature generally are consistent with a flat Phillips curve, which is to say that it requires a steep decline in activity in order to bring inflation down by even a moderate amount. The research staff at the Chicago Fed recently updated a version of this analysis that was based on the work of Romer and Romer 2004 and used data going back to the 1960s. Okay, so let's see if we can get this going. This chart shows the results for the log level of GDP, of employment, and core PCE inflation rate that we would expect to see based on historical relationships from Fed policy moves of the size that we've seen today. So recall that when the Fed first increased rates in March of last year, the core PCE inflation rate was nearly 5.5%. So if you look at the historical dynamics of what happens following a monetary policy move of the size that we have had, historically, the dynamics would show you that inflation, the one on the far right, is not expected to go down until sometime next year, and that it would come with a large recession in the GDP of the first block and employment, and the recession would already have started before the inflation began moderating. That's the historical pattern. It's getting smaller each one. The red lines are what actually happened. That's our actual experience so far. Notice that the real data have not followed the historical patterns at all. There are three in all three areas. First, on GDP, GDP fell more quickly following the increase than in a typical policy tightening cycle. And while the level is even with the historical pattern at this point, for it to match the historical, a recession is coming. There would still be a lot of GDP to go down. Second, employment's been much stronger than it has been in previous cycles. And third, inflation fell much sooner than it did in the historical average. And if the past correlations are to hold, inflation is going to go down substantially more to come by a large amount, and it will come with the downturn in the business cycle. Now, that traditional approach leaves us with a puzzle, which is that core inflation began moving down markedly in 2023, not mid 2024. And it did so when the job market was still strong, not after it had weakened substantially, and not coming after a big drop um, in GDP. For the traditionalist view, I think the only answer is, well, that must be noise. Just wait, the economy's about to get worse. That's what the past experience says. And that's possible. But I think another answer is that something very different is going on. Either non monetary shocks are heavily influencing the economy, or the nature of the monetary policy environment that we're working in today is different. And I believe both of those factors are at play. And if so, we should be extra careful about indexing monetary policy at this moment to the traditional view of what incoming data on output and the labor market mean for the inflation outlook. So let's start with the supply side and the sources of inflation. Recall that inflation began to soar in 2021, even as the unemployment rate exceeded 6% and GDP was well below previous estimates of potential output. That kind of elevated slack should have, in the traditional view, lowered inflation, not raised it. Also, inflation surged all over the world, including places with very different fiscal responses, again, suggesting something else was at work. In my view, the most important factors were COVID related. They were well documented negative supply chain shocks, unusual shifts in the composition demand, and add to the supply side difficulties that the fact that COVID reduced labor supply as labor force participation, especially for women and those nearing retirement, dropped precipitously and immigration virtually collapsed. There are analysts who do not agree with that predominantly supply shock view of what happened with inflation. They tend to observe that supply chain disruptions and severe labor dislocations typically impact isolated sectors and therefore show up as relative price changes rather than widespread increases in prices across the board. I think it's worth re-examining, though, the evidence on our actual experience, because I think a lot of the evidence now continues to point to the supply disruption channel. Chad Severson's contribution at the Jackson Hole Conference this year showed substantial differences in inflation rates over the pandemic to now across a wide range of industries. And those differences with the industries with the biggest price increases were also strong. That was strongly associated with having the smallest increases in quantity, fully consistent with the role of supply shocks as an important driver of overall inflation. Research with a more macroeconomic focus has also found a large role for supply shocks, like the recent papers by Bernanke and Blanchard, Liu, and Wynn, and our Chicago Fed dynamic stochastic general equilibrium model also ascribes a large portion of the run up to inflation to supply shocks as well. Now, fortunately, the negative supply shocks, the demand distortions, they have been unwinding steadily, and those have been important factors bringing inflation down over the past year or so. Most metrics indicate that supply chains have improved considerably. That's corroborated by our business contacts throughout the Fed system. And that improvement is likely to continue working its way through the economy. We've also seen strong increases in labor supply. The prime age labor force participation rate is at the highest level in more than 20 years, perhaps because of more flexible post COVID work arrangements. Female labor force participation rate is hitting record highs, as is the participation rate for those with disabilities. Immigration has strongly recovered as well. For all of these reasons, holding to the simple historical correlation of what a growth rate and labor market conditions mean for inflation in the face of these positive supply developments, that's a recipe for overshooting and causing an unnecessary downturn at a moment of transition like this. Tying monetary policy too closely to contemporary output labor market readings today risks giving a decidedly wrong answer. Okay, the second reason that I think that what I'm calling the traditionalist perspective on the current underlying economic environment, the second reason that perspective may miss the mark is the role of central bank credibility in keeping inflation expectations anchored now versus in past periods of high inflation. Okay, regardless of what you think causes inflation, if high inflation rates get rolled into expectations of future inflation, it makes the job of reducing the inflation that much harder. This we know. This is what happened in the 1970s. As the inflationary psychology took hold, breaking it became extremely costly. And it took much more aggressive tightening because expectations had ratcheted up over time. If the economic agents make wage and price setting decisions consistent with their expectations, then the inflation expectations become a strong attractor for actual inflation itself. This is long run inflation expectations as estimated by the Fed. And you can see that in the 70s, they ratcheted up. As inflation rose, people's expectations of what inflation would be in the future rose with them. Long run inflation expectations that are anchored at the inflation target can themselves just become an important force returning inflation to that target with less economic pain than was needed in these past episodes. And as can be seen in these graphs, uh, today long run inflation expectations indeed appear to be well anchored through the entire inflationary episode. They barely moved. There are different ways to measure them. The top panel shows survey based measures, the bottom panel shows market based measures, but they both tell a similar story that the long run inflation expectations, which are the red line, they basically did not move much at all during this inflationary episode. The idea that anchored inflation expectations can pull inflation down without as much economic damage as happened in the past when the expectations had lost their anchor is the second important reason to downweight the traditionalist view at this moment. Now, of course, the anchoring did not come out of thin air. It hinges on the belief in the inflation fighting credibility of the Fed that was well earned over time. And in turn, appropriate monetary policy actions and communications that are aimed at hitting the inflation target reinforce the credibility, anchor the inflation expectations, and they support the effectiveness of monetary policy. Now, there's a lot of research studying this channel of, of expectations. And one example is a model developed by two Chicago Fed economists, Stefania D'Amico and Tom Kane. The standard models, such as the vector autoregressions that capture the traditionalist view, like what I talked about earlier, they generally do not have any independent role for forward-looking behavior. They just pick up what's captured over time, the dynamics estimated in the model following the monetary policy shocks. What Stefania and Tom did is make a model that explicitly includes measures for private sector expectations of activity, of inflation, of interest rates, and allow those anticipations to identify shocks to both the current policy rate and shocks to the expectations of what people think the rate is going to be going forward. And the model estimates that this cycle, the public has formed an expectation for tighter policy well in advance of actual changes to the policy rate. And when they do that, they find the results show much more front loaded effects on both output and inflation along the lines of what we saw in the red lines of the actual data than the traditional analysis shows. And although the confidence intervals are large on these forecasts, the forecasts shown here, they have inflation reaching the target relatively soon with only a modest slowing in GDP growth. And that's what I have termed the golden path. the greatest of all soft landings, to have a large reduction in inflation without a large recession. And note, in this model, those outcomes are achieved without any further policy tightening. Now, I know some people don't like the specific assumptions of any particular model. So fine, forget the models. If you think expectations matter, just go look at them. Today, market participants largely expect the Fed to raise rates only a bit more and to hold the rates there for a while. And their economic forecasts generally show inflation getting down to target without a major recession, pretty much in line with the golden path. And as long as they expect that, it makes that outcome easier to achieve. Now, on a side note, the importance of inflation expectations and Fed credibility. If you believe that, that's why I think the recent ruminations about changing the inflation target to something higher than 2% are quite risky. To speculate on that now undermines the power of the expectations to bring actual inflation down. No matter what you set your level of target, no matter what measure of inflation you say you're following, the whole benefit of announcing an inflation target comes from the fact that people expect that you will do what it takes to achieve the target. So if you say you're going to raise the target, the inflation target, when inflation is above the target, that undermines the credibility of the commitment to any inflation target, and it impairs the very mechanism of how it's supposed to help in the first place. It becomes a recipe for the ratcheting up of inflation expectations when inflation rises, just like what we saw in the old days. Okay. I advanced to slide 7. there is no slide 7. So, unwinding of the supply shocks and the changing composition of demand returning to a more stable patterns and the Fed credibility are central to why I think it might be possible today to reduce inflation while avoiding a deep recession. And these factors also argue against putting too much weight on the idea that monthly strong labor market or growth conditions necessarily imply a stalling out of the disinflationary process. If we stick with the traditional view at this moment, we risk policy overshooting and unnecessarily derailing the expansion. Now, of course, the golden path is not guaranteed. External shocks pose serious risk to the outlook. And I don't have to remind several of the members of this audience that earlier, less challenging soft landings than the golden path, such as 1990 and 2001, were derailed by exactly these kind of external shocks. Today, we're faced with, again, rising oil prices, a slowdown in China, the possibility of an expanded and prolonged auto strike, and now the potential for a disruptive government shutdown. Each of these or all of these could have important effects on the economy, either directly or indirectly through consumer and business confidence or through financial markets. But that is where we are. So if I'm arguing that at this moment, the real side economic conditions are not the primary thing telling us how soon we'll get back to target inflation, what should an empirically minded data dog pay attention to closest over the next few quarters? I'll give you my big 4. One is watch the composition of price dynamics. I and many others have remarked on this before, so I'll just give you the brief summary. Core inflation getting back to 2% must come from a combination of falling inflation for goods, for housing, and for non-housing services. Before COVID, core inflation was actually running a bit below 2%. So there is some wiggle room to this statement. Over this pre-COVID times, we got to 1.8% as a combination of goods prices falling about 1% a year housing costs rising about 3% a year, and inflation for services ex housing around 2.5%. So scale those up a few tenths, and you have an idea of where you need to be to get back to 2%. If you take the recent 3-month annualized inflation rates, first note core CPI inflation is already down to 2.4%. We will update that for core PCE tomorrow, but we have made excellent progress. We would not be far from the target if we can sustain. Much of the improvement has come from goods inflation already getting back down to around minus 1% as it was before COVID. Housing inflation has fallen noticeably in recent months, and more is expected there given the leading data on new tenant market rents. The non-housing services inflation is still around 4%, and given the persistence of inflation in services, we can only expect a small gradual improvement on that piece. But that doesn't mean we're not on the path. I think what it means is that over the next few quarters, the key to further progress is not what happens in the non-housing services. It is what happens to housing inflation. Continued progress on housing inflation would bode well, but we must acknowledge that there is a risk that the recent increases in home prices could spill over into market rents and stall the improvement here. So that's a critical risk to monitor. Category 2, watch productivity growth. Here, there has been a little good news that affects the prospects for both growth and real wages. The productivity data are notoriously noisy, but it appears now as if we could be settling back into a trend rate of productivity growth that is not far from what it was pre-pandemic, instead of the lower rates that we were running through 22 and the first part of 2023. And if true, then the pace of long-run nominal output or wage growth that is consistent with the 2% inflation target would not be as low as some have feared. Number 3, don't obsess over the near-term path for real wages. Many have expressed concern that a tight labor market with wages rising faster than prices would result in a wage price spiral. Some have gone even further and implicitly are arguing that the Fed's stopping rule should be tied to getting wage growth down to a level that is consistent with 2% inflation. I think we need to be especially careful with that type of argument. It is true that over long periods of time, wages, adjusted for productivity, grow in tandem with prices. In the short term, however, wages are generally stickier than prices. And that tends to make unit labor costs a lagging indicator of inflation. That doesn't mean that wages are unimportant. They are a major input cost to most industries, but it does mean that we should not be using short-term wage growth to predict inflation in the near term, and that indexing our monetary policy decisions to short-term wage growth at a moment of transition like this would almost certainly mean overshooting on tightness. And fourth, of course, keep your eye on inflation expectations. As I noted earlier, their role is central to our effort. Expectations currently show a benign view of the economy and of the road back to the stable inflation target, and the fact that they do makes the job much more achievable. But if the supply conditions deteriorate, if we get the external shocks and they fade too quickly, or other factors are going to impinge on the disinflationary process, rising inflationary expectations could be one of the earliest signals that policy needs to adjust. At the end of the day, we are going to get inflation back to our target, whatever that takes. Inflation still needs to come down, and we cannot lose sight of the fact that the Fed has the chance to achieve something quite rare, in the history of central banks to defeat inflation without tanking the economy. If we succeed, that golden path will be studied for years. If we fail, it will also be studied for years. But let's aim to succeed. And like with my grandpa Jack's investment tips, let's be prepared to recognize when the historical lessons, even of the very wise, might not necessarily work for today's environment. I feel at this moment, perhaps we would do better following Grandpa Jack's West Texas ranch advice rather than his stock market investment advice, which his line was work till it's dark and then pray for rain. Thank you.
Austin, thank you very much. I regret that I didn't know your grandpa Jack. He was a man of great wisdom. I can see where you get some of your wisdom. So let me explain what we're going to do. Austin and I are going to have a brief Q&A session here, and then we're going to turn it to the audience, and we will definitely end on time at 10 o'clock. So let me start with saying, if I were put in positioning you when the famous, absolutely, there can join us. Can they turn it on? Okay. A small wardrobe change up here.
Mine too, or just his? Mine's fine. I'm louder than you. There would be a certain advantage if they couldn't hear him. I could just repeat anything I want. Is the question? Why am I so handsome and thoughtful? Oh, let me.
All right. So Austin, you put forth a great argument that one might describe as being in the context of hawk and dove, is very dovish. React to that.
Is that the question? Okay. I don't totally see it that way in the following sense. What I'm saying is, in a moment of transition where there's supply shocks going on and where the credibility channel has made it so inflation expectations are moving, looking back at what happened in the 1970s is not a great measure. And so don't pay as close attention to what's happening to, let's call it, wages, the unemployment rate, GDP growth in the short run. These other, just look at the prices. Now, if you take the housing inflation example, there's one where if you see the housing inflation in the CPI going back up, I'm going to be pessimistic and say we're going to have to apply more monetary policy restraint. That's a hawkish position. It's just don't pay as close attention to what traditionally you think of as if you think there's a relatively stable Phillips curve, then you're tempted to look at what's happening in the real economy as the measure. The only thing that makes that dovish in your language, I think, is that at this moment of transition, we're going from one side to the other. And so the argument not to pay as much focus on the real economy side feels dovish, but it definitely doesn't have to be. If you start to see the lack of progress on the price side, we will have to raise restraint. That's what I mean. We will get rid of inflation.
Okay, that's fair. So the most recent SAP, it's not quite a forecast, but the dot plot where your colleagues imagine things might happen, seemed to most of us to suggest at least one more tightening in the cycle, and then keeping rates a little higher than reasonably expected. Also seemed to suggest stronger growth and a little bit longer before we get to the inflation target out by a year or so. Would you normally roughly agree with that outlook? Where would, put another way, without, if you can disclose, where was your dot, so to speak, or set of dots in all of that, and in particular about the upcoming couple of meetings?
Yeah. So the SEP is, as you know, is kind of broken out by time periods, and I've always been more of a there's a history of the SEP and how useful is the SEP. I think the use is much more focused on the short run. And for the rest of this year, there was a balance. There were some that were at there won't be more increases. There were some that there would be one more, but that was it. We would condense down to a narrow range for this year. I don't like arguing about speculatively what do you think it'll be in a year and 2 years because it's like if they said, you're going to go if you come up Lake Park in Hyde Park, Chicago, you come to 47th Street, and you turn and get on Lakeshore Drive. If they ask you, are you going to stop at the stoplight? Like, well, it depends if it's green or it's red. I don't know. I'm not going to say. And so we're going to get observations looking out in the future. What I'm looking at are these four factors that I'm describing. I'm trying not to put too much weight on conventional measures of overheating on the real side of the economy. Let's look at the prices. So far, look, we'll see what happens tomorrow, and we'll get another read of inflation going forward. But we made really excellent progress on inflation in a way that, let's call the traditionalists, would have said was impossible. If you asked 9 months ago, will we get core inflation more than cut in half and the unemployment rate will be there, they would say, no, can't be done. So I'm open. I haven't decided what I'm going to do at the next one, but at this kind of progress, I feel comfortable with what I've said before is we're moving to a period where the question is not how much more is the rate going to go up. It becomes how long are we going to keep it here.
Okay. So let me then take it back to your speech. Your speech put heavy emphasis on a couple of topics. One, obviously, supply shocks, et cetera, and then the other, inflation expectation.
Yeah.
And you seem to put a lot of weight on a relatively rapid unwinding of the supply constraints, and fortunately, very targeted, very stable inflation expectations. Many people would have said, well, what about the demand side? What about fiscal policy? What about monetary policy that had been relatively accommodated for a period of time? No mention of demand side in your speech. How does that play into your thinking of how we got to where we are and where we are?
This is, of course, the is it a religious war? It's almost a religious war of the well, was it supply or was it demand?
Or both?
I think at the on looking back, I think it's you have to say it's both. There was high demand. It's why I alluded to the international evidence and the fact that the inflation rate is not supposed to soar when the unemployment rate is 6% or when output is not above potential. That's strongly suggestive evidence that some major component was coming from the supply side. I do think that there was a demand side component, and in a way, if you cut the supply side while increasing the demand side, you're going to have double problem. But as you know, everything in a sense becomes delta from last year. And so if you're in the camp that says the main thing that happened was an overheating of the economy from too much stimulus, monetary and fiscal, you kind of have the puzzle. It was $2 trillion the previous year. That becomes zero the next year. So like, why didn't it? Why didn't the inflation go away? And one answer might be, well, it got rolled into expectations, but it didn't. I show you the evidence; it didn't get rolled into expectations. So that makes me think that there was a demand component, but it wasn't as big, and it has faded off now at this point.
Okay, so I think it's helpful though, since you didn't put in your speech, to hear your thoughts on how the demand played. And what I'm hearing you say is, obviously, there's both supply and demand in play here, but supply dominated the demand story.
That's what I think the evidence suggests at this point. Now, like, as it was happening in the moment, it was kind of hard to figure out. But I think looking back, it's mostly supply.
Okay, I mean, then flip to the other side. So you've done supply and demand. You put a lot of weight on inflation expectations, Fed credibility, et cetera. Um, Two questions in that regard. One is, as you well know, I think maybe before you got to the system, there was a review that I would argue loosened slightly the 2% target by suggesting, since we had undershot for a period of time, it might be okay to slightly overshoot for a period of time.
To base it on average.
To base it on,
inflation
yeah,
over a
right.
period.
And for those who are technicians, sort of flexible average inflation
Yeah.
target, I think, is the long-term economy jargon for it. How does that play into your thinking about success we've had thus far in inflation expectations? And though I hear you say very clearly this is not a time to rethink the inflation target, I agree with you. The Fed itself has sort of said, well, we're open to inflation slightly above target for a period. How does that all play into your thinking here?
That's why I said whatever target you pick and whatever measure of inflation, and that we can have a legitimate debate, and we will. We've restarted Fed listens. The previous framework
Right.
that this average inflation came out of was the result of a Fed listens process that went around the country. They talked to everybody, and they came up with that framework. We've restarted Fed listens. We've done a bunch of events, and I assume that we will develop a refinement of the framework. But for all of those debates, that has to happen once you hit the target that you set before. It can't be like, oh, you know what, let's give up because we didn't get it. I think, I mean, it feels that the world is not totally satisfied with how things went down after announcing let's have an inflation target, and then inflation went way up, and then the question became, okay, you said you were going to tolerate a little band, let's call it a band of uncertainty of, inflation could be a little above. Did you mean this? How much it went up? Is this how long you meant? So I think we're going to have a legitimate debate about that. I think the fact now you can have that debate when you're at the target or below the target. You can't give up the fight to get to the target before the job is done.
All right. So do I interpret that as the chairman said, 2% is 2%, 2% is the target. We're getting to 2%.
Yes. Then the deeper question is 2% of what? Is like what's in the base and over what time period. And my thing with the inflation target, once we will get back to the target. Once we've done that and we re-engage, my thing about inflation targets is the false sense of precision to say 2.0, that's the target. And I was like, well, what about 2.1? No, 2.0. Inflation's an extremely noisy measure. So I do think we got to think about that a little bit.
And to be fair, there are those who historically and maybe within the state think that announcing an explicit quantitative inflation target probably may not be the right thing.
Did it make sense? And
Did it
I'm
make
sympathetic to that. And there's another argument that if 2%, does 2% wind you up at the zero lower bound too frequently? Okay, so there's a balance you're trying to trade off, not hitting the zero lower bound versus if the target's too high above 2%, is that effectively like not having a target? All of those are perfectly valid, and we're going to have that discussion once we get back to the target. That's
okay.
the way I see
All right. The message is clear.
it. Yeah.
For the audience, I'm going to ask just one more question and then turn it to you. So get your questions ready. So I've talked a great deal about where we are now in monetary policy. So let me talk about sort of the rest of your job, which is you're overseeing, a large staff and an important part of the country. What challenges, what lessons, any surprises in moving into this exalted position of being president of the
The
Chicago Fed?
exalted position. It's been lovely. It wasn't 100% a surprise because it's what I expected, and everybody said it. But there is still the Fed system is one of the most glorious mission-driven organizations in the entire firm.
More so than University of Chicago?
So the thing about being a professor, I was 28 years a professor at University of Chicago, and I love it, and I love academia, and it's if not solitary, it's much more solitary than not exactly a team sport. The typical moment of academics is you're sitting in front of your computer doing your work. You go talk to co-author. The Fed is absolutely team sport, but at every level, in every division, and the reserve banks are more operational. I'd say they're not just the monetary policy component is one part of the job, but there's a whole district, and we've got a community development function, and we're out engaging with the community. Um, and there's the just the management operation. We got $20 billion of cash in a vault. We got Brinks trucks coming in every day, and we're filling the cash machines for our banks. Um, at every level, people absolutely believe in the mission, and it's like we're putting a man on the moon, kind of a thing, and that's been wonderful. Um, the only surprise, partly going the other way, is I forgot the committees and the bureaucracy and the something at level. Oh, you want to do this? Well, wait, we need to be approved by the Conference of Presidents, umbrella committee. So there's some of that, getting back to the government policy, but the private sector, there are many things that the government or the Fed can learn from the private sector. And one thing that I think you've seen management experts recognizing in the private sector is a thing the Fed already was, which is the importance of mission, and that people feel like I'm a part of something that's bigger than just myself and just write my paper, and they live it every day. It's been wonderful.
Good. I'm glad to hear it. And now, let me now open it up to the audience for any questions. There's a mic obviously in the front. Please step forward, identify yourself, and then ask your question.
Hi, I'm Jean Whalen from the Washington Post. Many of the big auto factories are in your district, and I wonder if you could share any thoughts on the strike and how it might affect the economy.
Indeed, and I made a small allusion to that. We're the seventh district. We have the biggest auto production of all the Fed. We got Michigan, Indiana, Illinois, and even Wisconsin. This strike is unlike um, most previous strikes. Our we got a lot of expertise on the auto industries. They've gone and analyzed previous strikes, what happened to GDP, what happened to prices, um, and what are the economic impacts. The thing to know, of course, is it matters a lot how long the strike goes. If you look at past strikes, if they're short enough, they almost don't show up because there's typically, for whatever goes down, there's a very strong immediate rebound of production. So if it all happens within, let's say, 1 month, it doesn't. It almost doesn't show up in the quarterly GDP numbers. The longer it goes, and the more spread uh, across multiple companies, the more the short run impact. And the biggest extended strike is probably 1970 against General Motors. General Motors market share in 1970 was about the size of the market share of all the big three today. Historically, there's not that large of a inflationary impact, but the caveats of this moment are is a is a very different inventory situation and capacity situation among the competitors. So the thing we're trying to gauge, A, is how long the strike lasts and how widespread it is, but also we saw during the COVID times that when there's extremely low inventory, that can do wild short run swings in prices of cars, both used and new. And we're trying to get a handle on if this thing were extended, would we have a dynamic that is different than in previous strikes?
Great, thank you. Next question, please, sir.
Hello, Austin, Roger, Fred Hochberg. We're in the midst of a big energy transition. Uh, there's a lot of public sentiment against fossil fuels. Um, we have climate change that's impacting food, crops. We're anti-global right now. We don't like importing. We don't like immigrants. Um, Construction industry keeps talking about more and more inflation with a housing shortage. So those seem like really strong headwinds from what you've talked about. How do we understand those in context of what you said?
Yeah, but you mixed some short run ones and some deep longer run ones. I'm mostly just thinking about the next 4 months aspect. Um, and all I will say is each of those headwinds, as they're playing out in the next 4 months, is already baked into the cake. So I'm not disputing significant headwinds, and we could add some more on there. It's just that uh, our strength has so far been outweighing those headwinds, and it takes us to a deeper plane to if we start contemplating the climate risks, um, and some of the other long-term growth risks, population growth in the United States, and what does it mean if we're going to decouple? All the countries are going to decouple from each other, and trade is going to become unpopular. And if we were to reduce immigration on some permanent basis, uh, those would be serious challenges. But they're just not in the thing. The Fed's got a job, and Fed's going to do its job, and that is about stabilization, economic stabilization.
Any more questions from the audience?
Look at the time. No.
Absolutely. We have plenty of time for a question from David Wilcox.
I'm thrilled to meet Grandpa Jack today. Previously, you had
Uncle
introduced us
Bob.
to Uncle Bob. I can't wait till your next speech to hear the next colorful member of your family
From the Abilene, portion.
get their wisdom. You were very clear this morning about in your statement that today is not the right time to rethink the 2% inflation target. I guess I'd like to hear, draw you out a little bit about whether you think there ever will be an appropriate time to rethink the inflation target, what those circumstances might be, and what the analytical considerations are that would drive your thinking on that.
Okay, as expected, I would expect no less. Cogent and lays it out both short run and long run. I think we should think about. I wasn't that big of a fan way back when, before I ever was in the Fed. I wasn't a huge fan of an explicit numbered inflation target at a level of precision, 2.0%. Partly, I thought that feels like it makes it risky that we hit the lower bound, the zero lower bound, and has the full sense of precision. So that's a backdrop to say once we're to either a clear path to the 2%, or we actually observe 2% in some way that you can declare without falsity, we've hit it, we're back. Then I think it'd be perfectly appropriate to have the discussion about the 2% target. I know within the Fed, it feels like people think that was well debated. When from not in the Fed, I feel like it wasn't. I feel like if you talk to most people, they'd be like, "Where did 2% come from?" Some guy's head in New Zealand. He came like, "Would well, let's have a more fulsome discussion about those factors." And I still feel like if you had inflation of the experience we had pre-COVID, where we went year after year, let's call it, of inflation at 1.8, 1.8, 1.8. If you get a whole bunch of years in a row, the uncertainty band ought to be shrinking. It ought to become clear we're not at the target. Where if it's like, we got 1 month was one, and then 1 month was three, and then 1 month was something else, that uncertainty, I want the uncertainty band to kind of be applied to the target. That's my own. But I feel like the Fed listen/framework development, if that's being done in a context where we're inflation is not obviously above where we want it to be, it would be perfectly appropriate to think about it at a moment like that.
Yes. More questions, please.
Uh-oh. Uh-oh.
Nick Timmerouse of the Wall Street Journal. Since you all met at the Open Market Committee last week, the 10-year Treasury yield's gone on quite a run. It's up maybe 30 basis points just in the last week. Can you talk about how you're thinking about financial conditions tightening and how a move like that, especially if it's sustained or were to continue, would how does that trade off for Fed funds increases or for your view of the growth outlook ahead?
Uh, You're right to highlight. I would be calling you. Wait, well, what do you think is behind the increase in long rates? Um, I can't give you a specific formula of what's the Fed funds equivalent of a long rate increase. They're clearly related. We're still trying to process why this is happening on the long end. Is it that people took from it was a relatively subtle change to the SEP. So they just to set the stage of why there's a bit of a puzzle in this. The new SEP comes out. It's a little different than before, but it's a subtle difference. And then the long rate starts moving quite a lot. If you look at what it could have been, that expectations of future inflation were coming unhinged or changing, but it doesn't look like it was that. It could be that there's some change. Do they anticipate something is going to happen in rates that's very different from what they thought before? Might be, but as I say, the S&P didn't change that much. Is there some strange thing going on in the marketplace? That there's some liquidity issues? I'm still trying to chew on that. As a summary, long rates heavily influence economic decisions, especially the long-weighted decisions like business investment and mortgages and things that are interest rate sensitive. The Fed has always known that. It's why when we're at the zero lower bound, they first start engaging in QE. Is they're trying to say, well, maybe we can cut rates. Maybe we can cut long rates if we can't cut short rates anymore. So if that happens, if that continues, we will have to take that into account as a form of financial conditions and monetary tightening. I think it definitely is that. And so we should just incorporate it into our model. But I can't give you a number of if that goes up 50 basis points, does that mean you would do 25 basis points less, 6 months from now? I don't have that kind of precision.
We have time for one more from the audience if there is one. Let me let me then take the prerogative of asking the last question, which is we focus heavily on the real economy, monetary policy, financial conditions, Nick. Um, the other thing the Fed is always thinking about is so-called financial stability.
Yes.
We've had a period of some instability in the banking sector. Hopefully that's behind us. How does that play into your thinking in general and about the current conjuncture?
When it happened in March, anybody who was working there through the financial crisis, as I say, you couldn't get that awful smell out of your nose of like, oh boy, this feels the weekend, and they scrambled and they thinking it was like, oh man, if this is the beginning of some deterioration up to and include potentially including a financial crisis. Um, but at the least some credit crunch of the form that has followed that kind of thing before, that we would need to incorporate that into our monetary thinking because that's monetary tightening. Um, that's a it's like it was monetary tightening. I've been pleasantly surprised, maybe even stunned, but definitely pleasantly surprised that 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 shoe didn't drop. And the whenever you raise rates 500 plus basis points in a year, there's going to be tightening credit conditions. The question was always, is there going to be something more than what we normally expect in terms of credit tightening? so far, it really have not seen that. It's been pretty much on target with what we'd expect. We'll see how it plays out the commercial real estate, um, which is on the balance sheets of a lot of banks, and that's tied into the whole: are people coming back to the office? Are they going to stay working at home forever? So we still just have to see how that plays out. But I would say this one, if you'd have asked in March, by September, what we would be talking about, we probably would have thought, oh boy, we're really going to be talking. All we're going to be talking about is bank credit crunch squeeze, and it really hasn't played out that way.
Benjamin strikes me as a good time to stop. Let me thank you, Austan Goolsbee. I invite you to thank our speaker, Austan Goolsbee. Thank you.